Now we're going to do, I'm sort of starting tonight almost at the end. I'm not really starting at the end. I mean, we've gone through that. But I want to give you a case study on trading market condition. And then we'll go back and we'll talk about more of the theory behind what went into this case study after we're through with the case study. Okay, so this is the March 2013 Canadian dollar. This is very close to where we are in time. This is I saw this example and I thought this was just is a wonderful, wonderful lesson in trading market conditions. So if you're looking, and something else, the reports that I do at night and in the morning, there is a method to the madness of those reports. And when I tell you that, we have a bias to the downside of this market, we're favoring short trades, that's giving you information that you can use. And this is an example. This particular chart is an example of what you want to do if you, because I'm going through a bunch of different markets at night. And I very seldom spend much time on any one market. I don't have time to do it. You guys now, by going through this course, that report should be an invaluable tool for you each night and each morning to help you filter markets to trade. So how do you look at this market? Look at the Canadian dollar here, the Canadian dollar, and what do you see? Is there an opportunity here? How so? What is the opportunity? This is a bar chart. What are we seeing here? I mean, there's no indicators on here. Where's the opportunity? David, what's the KRA that this is near? Let me see if I can. Dare I try to use the drawing tools? Hold on a second. Okay, so David, I think what you're saying is this is the KRA, right? No? Okay. Okay, last 4 daily bars. Okay. Now, this really isn't I wouldn't call this a key, well, not really a key reference area. This is existing balance is what this is. This is a key reference area up here, and really, what is the market condition here on an intermediate term basis? It's down, right. And what is this? It's conviction, right? It's conviction. Now you guys can go back and you can listen to the DBSA, the pre-market reports. And when this market was trading up in here, actually when it started here, and I'm sure Troy was talking about this in the room, we were sort of looking at this 150 level as being important, because if a market, markets will retrace, it's normal for markets to retrace into conviction. But if the conviction is real, meaning that if the people that created the conviction, which is the big money, still are operating under the same assumption, all of that conviction should not be retraced. So when you see a market that sort of bungee jumps like this and it trades back into conviction and then it begins to set up like this, then you start to sit up and take notice. Now, the other thing, this is one view of this market. this is what you're trading. So if I'm looking at these markets at night, now typically my charts are annotated. I'll have this on here. But you want to train yourself so that you can scroll through charts really quickly, and you can see the balance areas that form. You can see the conviction, the two basic phases of market development. And we're going to talk, that's the theme of tonight, balance and imbalance. And you're trying to identify in which phase the market is presently trading, and you're trying to identify in which phase of one larger degree than that which you're trading, the market is trading. So you combine those two things to identify opportunity. So if conviction is down here, we clearly have conviction, and we clearly have balance. So what we're doing is we're defining the situation in this market. You know, we're not at the point where we're going to trade this. We're just identifying a situation that is increasingly looking like it's tradable. Now here, you know, you guys see me put these things in the charts all the time. And a lot of times, quite often, I'll get people that say, well, I thought you guys traded market profile, but I don't see any profile charts. I've had more than once phone calls from people, and they'll say, well, I'm in the trade room, and I haven't seen a market profile chart today. Where's the market profile? Well, we don't trade market profile. We use the profile chart. Sometimes you get a better view from a profile chart than a bar chart. Sometimes you get a better view from a bar chart than the profile chart. Now, if you look at this chart, which is giving you a better idea of potential opportunity and a more defining view of the auction process, this magic profile chart or this bar chart. The bar chart, right? Does anybody think that this gives them a better view of the auction process and the present opportunity than this? Now, and this is also important, people want to view the market profile chart in a specific format as a static entity itself that has magical qualities. And the beauty of the profile graph is completely lost when you look at it that way. You know, you want to begin to understand how to manipulate the profile graph, or at least understand what I'm doing when you get the reports, and I have manipulated the profile graph to see what the auction is doing. This doesn't tell me a whole lot. This is not particularly helpful. This is helpful. I can see the conviction here. I can see the migration of value here. I can see this balance area that's formed here. And then I can see, okay, now we've got some two-sided trade up here. And we're trading into this area of conviction. And I can begin to draw logical conclusions when I split out. And this is basically what this is. It's a bar chart, right? Each letter, instead of being a solid vertical line, each time slot, in this case, each daily bar, instead of being a solid vertical line, is a ladder. So your focus when you're analyzing markets as an auction market trader is to get the best read on what the market is doing from an auction market perspective. It's not about some slavish devotion to a particular market profile scheme based on its structure. So we're looking at the market, and we're looking at it to answer the questions: in which phase of development is the market presently trading, and in which time frame? And how mature is the immediate phase I am considering trading? Now, this is always a question. Excuse me, guys. pardon me, I had a sneeze. Sure hope we got that on the recording. This is the question that I'm always asked. Well, how do you know when a profile is mature? And my answer is you really don't know. You will get a feel for it. But the bigger point is that you don't have to know when a mature balance area is about to transition into imbalance. You can tell, and it requires going down into the smaller degree time frames to look at the cues, the tells that you get when that market is transitioning out of balance into another phase. So, there's this chaotic quest by a lot of market profile people, one of whom is Peter Stettlemeier, who keeps trying to uncover the Holy Grail and find that magical tipping point that consistently identifies when a market transitions from balance to imbalance. And it's not going to happen. The market's too dynamic for that. But it is certainly conducive that if you could do it to selling an indicator. But it can't be done. And it's pointless. You take your eye off the ball when you try to turn it into something mechanical like that. You're much better off just going down in time frames and looking at the smaller degree auctions to get an idea of which way this thing is developing outside of or down in time frame from the larger degree that you're trading. And this, what we've just discussed, is analyzing and trading market condition. And it requires knowledge and understanding. That's all it requires. I'm not saying it's simple, but that is what it requires. And there's really not much else that's going to help unless you have the knowledge and the understanding. Yeah, there's a question about candlesticks. Does it have value? And Raj, I agree with you. I don't think candlesticks have any value. Now, I will say this, and I can see a benefit in the candlestick view because of the wick thing. And basically, it will show you buying tails and selling tails very clearly. But I've never had any problem identifying these things on a bar chart. I started trading before candlesticks became, hyper popular. I'll also tell you that there have been studies done that have tested all of these combinations of candlestick, bars, 2 or 3 bars in a row that do this, that, or the other. And there's never been anyone that can show that there's an edge in reading that stuff. If you want to use candlestick charts because you use candlestick charts, that's perfectly fine. I have no problem with candlesticks, but there's nothing magic about candlesticks. I think probably, I don't know, Troy, you don't use candlesticks, do you? And I'll tell you another disadvantage of candlesticks, you can't see as many bars on your chart. So you can't, we are looking at market condition. We want the information. If I've got a bunch of fat bars on my chart because they're candlesticks, to me, I'm missing information. I'm not gaining information. Okay, now we continue to drill down and look at and decipher both the profile graph as well as the bar chart to give us the information we need. So, when you have this view, this is basically a balance area. And you want to begin to learn to recognize these auction market artifacts because that's your read. That's what you're trying to identify because they're very specific, they're very consistent, and they're objective. They're telling you something about existing value, and they're telling you something about past value. And that's important to know. So be sure and make note of how we're using and when we use the profile graph. We use it entirely that give us information about the auction process. You're trading an auction process. You're not trading the market profile graph, and this is important. There is not one static way of using the profile graph. There's not one special configuration with special areas and nodes and points of control and all of this other stuff that is the attempt to brand and to turn it into some sort of magic, because it's not. It can be an extremely powerful tool, but only from the perspective of helping you to see what's there that perhaps at times you can't see better on a bar chart. But it's clear, I think, that there's certainly times where you got to have a bar chart to get the best read on that auction, especially when you're looking for transition out of balance. Now, this is a view of the smaller auctions. So is this helpful? And this is that area that we're looking at. No, it's not particularly helpful because you don't really get the context. I mean, you can, you know, it's very easy to glob together different sessions and days and come up with these Gaussian shapes. But if you don't put them into a context, they're not particularly helpful. Now, when you have put the market into a specific context and you have identified a market condition and you've identified something that might be tradable within that context, then this can become very, very useful. And this is what you end up with. So when we look at this, it is very helpful, given the context in which this is occurring, then to go down to the profile view of this, because as you will see, this is sort of the base schematic of what we're looking for that gives us the information we need to trade. And what is that information? It's the three primary key reference areas: the upper extreme of an auction, the lower extreme of an auction, and the high volume node of an auction. And this fits almost perfectly into that Gaussian view that we like to see. And it doesn't always occur that way. I understand that. And you guys need to understand that. But it does occur this way a lot. But this itself, there's no magic in this. The magic in this is understanding the context in which it's occurring. This is a smaller auction that has the break of this smaller auction has much larger implications than just the random break of a smaller auction. And that's what you want to try and identify. If you use these concepts to trade, you can use these concepts to trade randomly, and you don't want to do that. Just because you have a small degree auction does not necessarily make it, not all small degree auctions are equal, let's put it that way. I can show you identical structures to this in this same market that does not have the potential that this particular structure has because of the bigger picture. And that's, again, that's the essence of what we're doing, and it's the essence of the robustness of the methodology, is that the auction process is in effect in all degrees of time all the time. So you try to identify the larger degree auction, and then you go down the time frame, down the time scale, to get more granular, to identify opportunities that give you the risk of the smaller auction with the potential of the much larger degree auction. So we're beginning to get there when we have drilled down to this point, and we put this in a proper context. Now, this is this. Let's take a 5-minute break here real quick. We've been going just about an hour. Let's take a 5-minute break. Okay, guys, sound check. Am I being heard? Okay. There's a reason I always check that. Troy will tell you. Okay, so here we are. We've drilled down now. We've identified an opportunity. Now we want to start, the analysis part of it is for the purpose of identifying trading opportunities. And that's something else that is implicitly unique about this methodology. This is a trader's methodology. Its explicit purpose, the way we apply it, is to identify trade opportunity. We don't use it to predict dramatic things. We use it to identify trade opportunity, and we stay as objective with it as we possibly can. And that's unique. It is truly a trader's methodology. It's a trader's form of analysis. So now, as traders, this is a 30-minute bar chart. That's sort of our standard that we try to look at. You guys have seen me, and you'll see Troy use, we look at daily, 120, 30, and then 5-minute charts. That's perfectly fine. But in terms of identifying opportunities, 30 minutes is a pretty good time frame when you're drilling down to identify opportunity. So now, what do we see here? What do we know based on everything we've seen up to this point? Talk to me about this market. Long balance. Michael, yeah, that's one thing I really wanted to say. Yeah, David, mature balance. Yes, mature balance, exactly. And that's what you want to ask yourselves. I mean, could this thing go on and on and on? Yes, but it's at a point now where it justifies the risk to begin looking for that initiative trade. So you don't know if it's going to break out on this swing. You don't know if it's going to break out on this swing or the next one. But if you're trading in here, your risk is minimal relative to the potential reward. So you're still defining your trading, and you're not going to get hurt. And over the long run, there is a huge edge in doing this. That's why you don't have to obsess over knowing exactly when a balance area is going to break and it's going to trend up or it's going to trend down. That's a waste of time. Give it up. I'd like to be able to consistently do that myself. But you can consistently read when a market is about to break. And if I'm not mistaken, I think it was James says, it looks like, if I'm looking at this, it looks to me like, gosh, maybe this thing's getting ready to break out. Now, there are a couple of subtle things. We had some nice conviction up. We had a retracement, and that retracement held what is the high volume node, right? And then we V-bottomed, and we traded higher. Now look, and we're forming a tiny balance area. Now, I say tiny, this is 3 or 4 hours. So if we were to go to a shorter term time frame, a 5-minute chart, this would be a balance area, wouldn't it? So when I'm looking at this view, what I'm seeing conviction up. I'm seeing that we retrace down back near what would be the high volume node on the profile chart. And then I see conviction again following through, and the market balancing up in here. Now, at this point, what would you do? What would be a trade here? Is there more than one trade here? Yeah, yeah, there is. Well, what is it? All right, let me do this. I'm going to go short. Why would I go short? Where would I put my stop? And what's my potential for the trade? David, the potential for the trade at this point is at a minimum the range of the balance area. Actually, it's outside the balance area, but at minimum the range of the balance area. And if I sell this, if I sell this right here, I don't want to see this above, and I don't put stops. I won't say never, but I don't put stops a tick or two above an obvious level. I'll put it 2 or 3 ticks above it. So if I go short here, my risk is about here, and my potential is down here. Well, I don't need a calculator to know that that trade has a favorable reward to risk. And I don't, in something else, and if you're a newer client, you may be sitting there going, well, how much money is that? Well, and this is a very, very good question. Just because a trade may have a 10 to 1 reward to risk, you don't take the trade if you can't afford the 1, if it happens. In this particular instance, it's probably, your risk is maybe $100 or so in the Canadian dollar, and your reward is a multiple of that, 3 or 4 times that down to here. But this is something else that's different about market condition trading versus price-based trading. You cannot assign a dollar limit to a trade plan, trading this way. You can't do it. Or if you do, let's put it this way, it's going to really restrict your opportunities if it's too small. You can't come into this and say, well, I can only afford to risk $75 a trade. So therefore, I'm going to trade all day long with a $75 risk. Well, you're going to lose all your money. The market doesn't care. And you are under that. When you do that, if and when, it's not if, but when volatility changes, if you can trade with a $75 risk something, and you can't, even in the S&P Mini right now, it would be extremely difficult to consistently trade with a $75 risk. That's a 1.5. Very, very difficult to do. You'd have to be almost perfect with your entry to do that. And you don't want to trade based on having to achieve perfection. Now, the good news is that there's a large margin of error in applying these concepts, even under a relatively rigid rule set. But be careful about trading money versus placing a stop where that stop has to be. A stop is placed where it invalidates the trade. It has nothing to do with money or what you can afford. If you can't afford the magnitude of the risk of a trade, don't take it regardless of the potential reward. And actually, the Canadian dollar is a great market to trade because it is a market that you can generally trade with less initial risk, less initial exposure than most other markets. Okay, so I have posited if I wanted to go short here, I would go short somewhere in here and I put my stop up here. Now, if I wanted to go long, if I'm going long, where do I put my stop? Under the small balance area. So you're going to put it somewhere under here, right? You know, not exactly there, but say here, right? Now, what I'll do, if I'm going to go long here, Initially, I'm going to give it some room. I may not go all the way down here, but I'm not going to put it right under this. You'll get stopped a lot of times. Yeah, well, you'll get stopped. I'm going to put it somewhere down here in this conviction. Now that increases my risk exposure, but it also increases the probability that the trade's going to work, if it's going to work. If I put my stop too close in here, guys, that's one of the big mistakes I see so many traders make when they're trying to apply these things. They want to use real close, tight stops, thinking the market is always going to honor, the exact tick of a balance area. So I'll put my stop where if I think this market's going higher. Look, you're trading an initiative opportunity. That's what you're doing when you're trading a balance area. And an initiative opportunity has an inherent edge. That's part of the beauty of trading this way. There's a large margin of error in this. You don't have to use that super tight stop. And you really shouldn't. The market, you've got to give the market some room. And that's what will, it's just another subtle thing that's going to separate you guys from the way everybody else trades. If I'm stopped out, I want to be wrong. I don't want to be stopped out by a tick because I tried to get too cute with a stop. Now that said, I don't care what you do, you are occasionally going to get stopped out by one tick. There's no hiding from it. You can't get away from it. So that's just part of trading. But if I'm going along this market based on what we see right here, my stop's going to be down here. It's not going to be here or even here. I'm going to put it somewhere down here in the conviction. Now, another reason I'll do that is because, and this is just the reality of discretionary trading, I have developed a pretty decent read on what's going on. So I tend to be right, at least initially, in my trades. Raj, everybody, it's not just you, Raj. Everybody gets stopped out by one tick. Me, you, Troy, we all do. Okay, so here are the salient points about this. It's potentially mature profile. The most recent conviction is up. So really, if I'm not asleep at the switch, the trade to take is to assume long, because that's where the conviction is. If you've heard me speak in some of the infomercial webinars that we're doing, you'll hear me talk about the inherent edge, and that if you would just identify from these areas that there's an edge here, whether you flip the coin and went long or short, if you took enough trades, over a large statistically valid sample of trades, you would have an edge, and you should, at the end of the sample, have a positive return. But you don't have to do that, because most of the time you're going to get a tell about what's going on, and you don't just stop the thought process just because you see a balance area and you're up here and flip a coin. You don't have to do that. You want to use these other artifacts, and you want to use the fact that the auction process is in effect in all degrees of time all the time to help you identify the direction that you want, in which you want to take the trade, that has a greater than just random chance of occurring. So you're in an area that has a greater than random chance of a sharp move, and you have information that gives you a greater than random chance of picking the direction. So you try to put those two things together in a consistent manner, and it's a pretty powerful combination of events. Am I missing some questions here? Let's see. Did Christine have a question about, I don't see her question. Oh, here it is. Do you move your stop up as the trade goes your way? That's a great question, Christine. That's a great question. We will address that very, very shortly, okay? You want to be, in general, you want to be careful moving stops. You've got to give the market room. Even initiative moves will have retracement in them.